So incomplete records, as the name suggests already, it means the records are not complete. Therefore, all rating is like gg.com. So what you're going to do in this chapter is like you're going to fix the puzzle. This chapter is like you are doing and playing a puzzle. It's a puzzle building, puzzle solving question. Okay. And then this chapter, if you are able to master this chapter 17 for incomplete records, you will be able to master club and societies. This chapter. Because the way of doing is pretty much the same. The way how they do things is quite similar. Yeah. Okay. Let me. Okay. So this is the syllabus that I'm planning. Would love to finish by around May, the first 2 weeks of the May. Okay, then after that, we'll be having revisions and tests. Okay, so incomplete records. So normally this one can happen in small business, small businesses such as grocery shops, where everything is very chin-chai ma-chai. You have, I think you, as well, Chinese, sometimes we can hear this word chin-chai, right? Do things very chin-chai ma-chai. So it means you never really follow the rules. You're just like, whatever, how you feel like recording the data, you just record at your whims. So why can have such thing happen? Well, of course, first, number one, never follow the dual entries. There's no proper debit credit. You just do your own debit and you never do credit. Or you do credit, but you never do debit. So this chapter is like a little bit doing like what? Your errors chapter, the suspect account part. So complete omission from business transaction, yes. Totally never record at all. So yeah, you miss out things. Then accounting records are damaged or stolen. Yes, it can be damaged or stolen due to fire and also floods. Source document not physically guarded, meaning you never put your file or everything into a cupboard that is a fireproof or bulletproof, waterproof, physical control. So this is called physical control. Okay, physically guarded. So you never put into a high rack, the cupboard. They put quite high, you put very low, so water go pass by, then bye-bye. Okay, so what will happen? What are the adverse effects? So trial balance cannot do. Then once you cannot do trial balance, you cannot do financial statement. You cannot do financial statement, then you cannot do the profit loss. You cannot do profit loss, also meaning you cannot count asset liability and the capital. Then when all these things GG, you also cannot do any decision making. Because why? There might be inaccurate references. When you want to do your comparison of analysis, you also can't do at all properly because all everything is not really right. The figures that you provided in the financial statement may not be trustable. It's not verifiable. Because why? There might be errors here and there already. Because the records are not complete. So when this thing you're doing with all this, right, what will happen is also there will be misappropriation and fraud cases. Meaning if there's a naughty fella inside there, when that fella sees some loophole, when the accountant in the small business, they are not really following the dual entry, all this, right? They can go and play around and steal money. Okay, that's what it will be. That's what are the disadvantages of incomplete records. So normally the question will say like who and who they are not follow the proper accounting records, and they will ask your help as the accountant to help them draw up all their financial statements. So here got two types of methods. Here got two methods in doing the incomplete records. So first one is called the capital comparison method, where they use the asset and the liabilities. They do comparison between these two at the beginning of the year end. So the question is just very simple. They just have 1st of January, all the details, and then 31st December, all the asset and liabilities. That's all. They just give you three columns, all the items. These are all the numbers. The question will be like this. Method 2, analysis method, is they give you 1st of January, 31st December, just like above, all the numbers, all the items, and there will be another, like a T account here, is all the payments and receipts. It's like basically your cash books. This is when you know you're doing method number 2. So method number 2 is very comprehensive. Yeah, they ask you to draw up everything, all their this income statement and also the SOFT. But for method 1, capital comparison method, you don't need to do as much lah. You just have to do a few things here. You'll be only doing like three stuffs. First, you have to do statement of affairs for the beginning and the year end. It's basically like SOFT. Just that the purpose is to find the capital balance amount. Also, basically what they are actually doing is like asset is equals to liability plus capital, right? So they just want to find the capital. So you just take all the amount that you calculated in your asset minus all the liabilities and you get the capital amount. That's what actually they are doing. But you have to draw up an SOFT format. Then you get the capital as the balancing figure at the beginning and year end. And normally beginning is what we are doing is like a copy and paste. But for the year-end part, there may be adjustments involved. What kind of adjustments? Provision for doubtful debts, depreciation, and lots more. Basically all the adjustments that you've learned and all the errors, corrections that you've learned. Yeah. Then be careful for any drawings if they have, and then further capital and any additional things they bring in during the year. Then after that, you prepare a statement to calculate profit for the year. How to find the profit is either like using the capital account, or it's basically like this: capital, opening capital, plus additional capital introduced. Okay. Then plus profit or minus loss, which is normally the unknown figure, minus drawings, and you get closing capital. Closing capital. So all everything you found already, right? Then you just do like what? Linear equation. Closing plus drawing minus additional capital minus the opening capital. Then you get the profit or loss for the year. Or sometimes just use the capital account, basically. Yeah. Yes, bro. Yeah, wait for you. You call me. You want to type something? I'll wait for you first. Can I use closing minus opening plus drawing minus capital? Up to you, up to you. Okay, just the other way. You're just basically doing backward accounting, backward calculations, that's all. Closing minus opening minus additional, and then plus drawing. Up to you. And that's the way I'm doing. That's the way we are doing. Yeah. To find the X. Okay. So this is our focus for this week. This one, NITA question. Questions on NITA. Okay. So this part, they give you flower shop, does only single entry. Well, okay. On 1st of September, she provided the following information. This is the 1st September, so the ending will be when? 31st August. So this is the beginning. This is the beginning. So how you going to do? Okay. You have to know everything they are liability or asset. So premise asset, accrue liability, you're going to minus off. Okay. So your first step is classify everything into asset or liability. Okay, long-term loan, liability, non-current. Okay, current liability, current, NCA, NCA. Okay. So then they say during the year depreciation. Okay, that is later on part. So here the question asks you first. Statement of affairs on 1st September showing the total capital at that date. So basically, statement of affairs, you are like doing another SOFP only. So NITA, statement of affairs at 1st September. Okay, so this is the beginning. So non-current assets. You have premise, 80,000, fixtures and equipment, motor vehicle, current assets. Okay, there's no any inventory, so straight receivables. 4,100. Bank, 2,500. Okay, so add up all. So this is the total assets. Then we have capital, which we do not know. Current liabilities, we have wages accrued, 600. Non-current liability, long-term loan, 20,000. So what you're going to do here is, first, you need to know and you're very confident at your asset allocation here. You need to be very sure that all the assets that you allocated here is all the correct assets. Okay, so what you're going to do next is straight away take the total asset and put into here. So you minus off 104,400 minus 20,000 minus 600, and there you go, 83800 opening balance. That's how you do it. Can? Okay. So this is your answer. You're basically taking asset minus liability and the asset minus liabilities, and then you get capital already, but in a different way. Right now, the second question is this: prepare statement affairs for the 31st August, showing all the total capital at the date. So for 31st August means got adjustments. So meaning to say, you need to do adjustments on the sentences below here there. Okay, so you have few things to do here. One is paid out the long-term loan. Second, bought new equipment, taken this much from the bank, personal use, and then fixtures and vehicle and motor vehicle. Fixtures, equipment, as well as motor vehicle got 20% on the cost of the asset held at year end. After that, accrued trade receivables. These are got some extra info here, and then bank overdraft, extra info over here. Okay, so you do the adjustments on your own first and try to see whether you can get 87800. I see you at like about 815. Yeah. Okay, you got the answer 87800. No. Almost there. At least the number that you get is almost there one. Okay, now first one, paid off half of the long-term loan. So meaning the long-term loan reduced by 10,000. So it's 10,000. Second, she bought new equipment costing that 1,000. Taken some money for personal use. Okay, so this was done during the year. So taken out. So this one is drawings. Bought new equipment. So there's a new equipment plus 1,000, and that will give you 7,000. Depreciation, fixtures and equipment as well as motor vehicle, 20% of the cost of the asset held at year end. So at year end, fixtures and equipment you multiply. Premise got nothing. So it's the 80,000. For the fixtures, so meaning 7K times 20% then 1,004. So it's 5,006. Motor vehicle also 20%, so 11800 times 20%. 2360. 9440. On the same date, wages are accrued by 570, so there's a accrued wages. 570. Trade receivables is 4750. Bank overdraft 1420. Okay lah. That's all it is. Nothing much. Okay. There's no any capital introduced. Okay, 80, ding, ding, ding. So, minus 10,000, minus 1990. So it's 87800. There you go. You must make sure all the assets is correct. Then only after that, you straight away take the total the other side as the total. Okay, which one you wrong? I suppose it's the depreciation, right? Because the keyword is held at year end. Cost of asset held at year end. So you no need to do prorating for the new equipment that she bought for the 1,000. So there's no need to do the one current asset. Oh my God, bank overdraft. So this is the beginning. The ending, we do not know what happened. So you just have to find what they tell and they just put accordingly lah. Okay. Then lastly, statement to show the profit loss calculation. So statement of calculation of profit or loss for the year ended 31st August 2026. Okay, so you just do terbalik from the closing capital 878, drawings taken for personal use 4,005, 92300 minus opening capital. How much? 838. So there you go, 8,005 profit. This is a profit for the year. Okay, then the last question they ask, what is the disadvantages of not maintaining full set of accounting record? That one, the answer comes from here. What are the effect of not? What are the bad things? This all everything. all these adverse effect will be the answer. Okay. Any questions? No. Okay then. So we stop to here today, and we continue again next week lah.